But Oliver Stone, despite his best attempt, was not all that successful in turning the world off of investing by portraying them as evil. Plenty of firms were starting at that time. Horseman Little, Welsh Carson, in Cleveland Blue Point and Ensalada, and of course, Little Riverside, which started at Bela Ziggy's dining room table, and there you can see him. Then in the early 90s, along came the RJR Nabisco disaster, the collapse of Drexel, and the S&L crisis, and there was a slowdown in this big expansion of private equity. Didn't really last for long because the rise of the internet created a lot more opportunity for venture and private equity, and things percolated along with a few blips until about 2007. And in 2007, we had sort of access to cheap credit, no covenants, and these humongous deals got done. So this was the age of the mega buyout, deals like Chrysler and TXU, and it was also the year that some big firms like KKR began to go public. The Services International Union launched a massive anti-private equity campaign. Leaflets, public demonstrations, etc. So, now that was sort of how private equity got launched. Then, of course, 2008 happened, and private equity, along with everyone else in financial services, got lumped into this whole group of people who were generally evil. It should come as no surprise to everyone, with no one telling the other side of the story about the good that private equity was doing, that policymakers were not inclined to be very supportive. So we were besieged by a wave of regulation around the globe. And if you think we have problems, just ask John Sada about AIFMD, which is probably why he's getting emails from us at 2 o'clock in the morning. Because, this is a worldwide issue. A lot of the regulations for private equity really didn't make sense. I had an experience with Mary Shapiro when she was head of the SEC, and she said to me, so could you explain to me how Riverside is monitoring its daily trading volume? So I said, well, last year we either bought or sold about 50 companies, so on the other 200 working days, I guess we were doing nothing. So it was really disturbing to know that the head of the SEC understood our business so little. So, 1,500 people saw that as compared to the 11 million who saw Wall Street, so you can see the problem. But this was a huge start for an industry that had really tried to stay private for 35 years. And there's lots more of these stories around on the ACG website, which you can sort of look at. So when you really think about smart comp, the middle market is way more interesting and way more sympathetic than anything that's happening in the big firms. In 2007, large deals accounted for half of the deal volume if you measure by enterprise value. But today they only make up about a third of deal volume. If you measure by deal count rather than enterprise value, deals under $1 billion accounted for 98% of what was done in 2013, and deals under $500 million accounted for 90% of that. So really a good time for the middle market. Middle market firms generally are more cautious, they put less debt on their deals, and they have more levers to pull to get growth. So they can really drive performance. So let's just sort of review some specific trends about what's happening today. Fundraising remains difficult. Back in 2007, as an industry, we raised about $275 billion, and we've raised just a tiny bit more than that in the past 2 years combined. When you think about fees in the private equity industry, it's kind of weird. I mean, how did that 2 and 20 thing even happen? And I'm not sure it really makes sense that KKR at $40 billion and Riverside at $4 billion should have the same fee structure. So what you're seeing now is LPs really understanding that and asking for budgets. They want to see, how much money do you really need to operate, et cetera. So a lot more interest from LPs on that. Then there's sort of a group of LPs that have what I'd call religious issues. They won't even it doesn't matter how your business operates or how you're getting returns. If you don't agree to no sharing of transaction and advisory fees, you can't even get through the door. If you're not ILPA compliant, you can't get through the door. Pension funds are particularly powerful here. They represent 43% of the money that goes into private equity. In fact, at Riverside, they're about 60%, so really a powerful group and one we all have to watch carefully. On the deal side, Chuck said to me this morning, could you please get some deals done? But I'm happy to say I do think things are heating up. There are more buyers than sellers out there, so that's really driving multiples. For a good deal, you still have to pay a lot. The average multiple in 2013 was 10. That was the average multiple. So I think we all have to kind of get used to this as a little bit of the new normal. Despite the high multiples, we are still seeing some exciting opportunities. We still see them in healthcare. We still see them in software as a service. And interestingly, we're seeing more specialty manufacturing opportunities. In fact, 4 of the last 10 platforms that Riverside has purchased were in that sector. So while early 2014 was a little slow, things really are picking up. One of our fund families is currently chasing 11 platforms. Last year they only closed 4. So I think hopefully that's a sign for everybody. I expect this trend is going to continue as baby boomers are still looking to monetize the companies they've built, as private equity firms and just middle market firms in general are looking for growth through add-ons. I mean, you're not getting a lot of lift from economies around the world today, so one of the ways to do that is to go acquire something. And then there's just my own personal theory. I think investment bankers can now dump 2009 from their presentations of 5 years financials, and I think that's really helpful in bringing companies to market. As we're all painfully aware, any private equity firm with more than $150 million in assets has to register with the SEC, and my chief compliance officer is here, so if I get tackled in the middle of this and drop to the floor, you'll know why. And abide by so we have to abide by this whole new set of rules. So now that we're into it, I can say that there are some of these rules that are actually good for the industry. Having policies that deal with document retention, plans for disaster recovery, those are really good business practices. And increased transparency around reporting to investors, particularly with regard to valuation, that's good for our industry. And honestly, having to write down your conflict management policy, that's not such a bad idea either. But not all of these rules are helpful. Some just don't work. Whether carry is a capital gain has been debated for the past 5 years. The great news is, through lots of educational work, there are actually people in Washington now who understand that a long-term investment in a capital asset, whether the gain is made through financial equity or sweat equity, is a capital gain. That is the definition. So if you're going to change this rule for private equity, you also have to change it for real estate, for venture capital, and for any other business owner who has made a long-term investment in a capital asset. One of the big issues we're working on right now is this deductibility of interest issue. While it wasn't in the current tax proposal, Ron Wyden, who's the senator who's the new chairman for Senate Finance, is a huge proponent of eliminating deductibility of interest. So when you really think about that, every company, private equity backed or not, uses some form of debt to grow. I took a little sample of our own companies and I said, what happens if we eliminate deductibility? It took everybody's marginal tax rate up to 52%. So you'd have to drop the rates to like 20 have this make any sense at all. So, this idea that they're going to get a pay for a lower corporate tax rate by doing this has tremendous collateral damage. So, one of the things you all can do is start to look at your companies and give ACG some data, whether, to Joan or to Global, because it's really helpful. And Ohio has 679 private equity-backed companies. 423 of them are in Cleveland, Cincinnati, and Columbus. And if you look back over the past 10 years at the job growth in those companies, it's 31%. The rest of the companies in Ohio grew at 4%. And so it's really a great business, but it's getting harder. Lower fees, more competition for deals, and more regulation. It's also getting harder to find organic growth for our portfolio companies. So like our portfolio companies, we just have to get more efficient and more creative. So I guess that's the challenge for all of us.